Hey everyone, so ever wonder how a conflict happening halfway across the world can suddenly cause a panic right here on Wall Street? Well, that's exactly what we're diving into today. We're going to unpack a single, absolutely chaotic day when a crisis overseas sent the markets into a total nosedive. It's a perfect example of just how connected everything is.
So let's just start with the headline number, the one that made everyone's stomach drop. At its lowest point on March 3rd, 2026, the Dow plunged over 1,200 points. I mean, wow, that's not just a bad day, folks. That is full-blown grade A panic. And really, this is where our story begins. So, okay, that number naturally leads to the big question, right? What on earth happened? How did a conflict in one region manage to set off a global financial freefall in just a matter of hours? Well, that's what we're here for. We're going to connect all the dots for you.
All right, so to really get why the market freaked out, you've got to start at the epicenter of it all. And look, this wasn't some minor border skirmish. No. This was a full-on geopolitical earthquake, and you better believe the financial markets felt every single shockwave.
So what kicked off all the chaos? It was this, the launch of something called Operation Epic Fury. And this was a massive, coordinated military campaign by the US and Israel. We're talking over 1,700 different sites targeted inside Iran. I mean, this was a huge, dramatic, and very, very serious escalation. And Iran didn't just sit back. Their response was incredibly fast, it was widespread, and it was, let's say, creative. They basically unleashed swarms of drones, and they went after some very sensitive, very visible targets, like U.S. embassies in Kuwait and Saudi Arabia, and, this is the really critical part, a huge oil terminal in the UAE.
You know, when you look at what they hit, you can see the real goal here. This was anything but random. The Allied strikes took out a leadership complex in Tehran, they bombed the entrance to the Natanz nuclear facility, and get this, they even targeted the Assembly of Experts. That's the group that actually picks the next supreme leader. So yeah, this was a really strategic campaign designed to hit Iran right where it hurts, its core infrastructure.
And just in case anyone was hoping this would all be over quickly, well, this statement from President Trump pretty much ended that hope. He made it clear this wasn't just a one-off strike. No, he said it could go on for weeks. And for the markets, that one word, weeks, it meant one thing and one thing only: a long period of painful, gut-wrenching uncertainty.
Okay, so now that we've set the geopolitical stage, let's talk about those financial aftershocks we mentioned. Let's trace exactly how all that fear and uncertainty turned into pure chaos on the global markets.
Man, if you want a picture of the mood on Wall Street that day, this is it. This is the VIX, which is basically the market's fear gauge. Usually it hangs out below 20. But on March 3rd, whoa, it spiked to over 28, the highest it had been in months. This right here, it's a chart of pure, unadulterated investor panic.
So the first thing to get hit, and hit hard, was oil. Brent crude, that's the global benchmark, it shot up by about 10%, just like that. And why? Pretty simple, actually. Traders were terrified that the fighting could shut down the Strait of Hormuz, which is literally the most important choke point for the entire world's energy supply.
And look, this oil shock wasn't just about paying more at the pump. Oh no, it unleashed Wall Street's absolute biggest nightmare, the fear of stagflation. And stagflation, it's this nasty, toxic mix where the economy is slowing down, but prices are still going up. It's the worst of both worlds, and that sudden spike in oil put that fear front and center.
Okay, now this is really interesting and maybe the most telling part of the whole day. You have to look at what the bond market did, because it was completely backwards. Normally, when there's a crisis, everyone runs to the safety of U.S. bonds, right? That's called a flight to safety, and it pushes interest rates, or yields, down. But on this day, the opposite happened. People were selling bonds, which pushed yields up. And what does that tell you? It tells you that the fear of inflation from that oil shock was even stronger than the fear of the actual war. That's wild.
So, as you can imagine, a crazy day like this created a really clear divide in the market. As all this fear took over, money didn't just vanish into thin air, it moved. And it created a very stark picture of winners and losers.
And here's the play-by-play of where that money went. You had defense stocks. They jumped 3 to 4% because, well, people expected a long conflict. Energy stocks, they popped 5% right along with oil prices. But on the flip side, the airlines just got hammered by the thought of soaring fuel costs. And all those high-growth tech stocks, investors dumped them. They're just seeing as way too risky when there's this much uncertainty in the air.
Now, it's true, the Dow did recover a bit from that crazy 1,200-point low. But don't let that headline number fool you. This chart really shows you the true health of the market under the surface. Nearly 3 out of every 4 stocks in the S&P 500 finished the day down. The selling was broad, and it was deep. It was a really, really rough day overall.
Okay, so we've gone through the military action, the market panic, the whole reaction. But what does all this actually mean for you? You know, for someone who isn't a Wall Street analyst staring at charts all day. Let's boil it down to the key takeaways. You know, one of our sources actually had some really solid advice here, and it's worth repeating. It basically says, try to ignore the crazy day-to-day swings in the Dow. Instead, just focus on the few things that really matter in the bigger picture. That means keeping an eye on the war itself, watching the next inflation reports, and listening to what the big companies are saying about their future plans. So, building on that idea, here are the 3 big things to watch going forward. Number 1, inflation data. We need to see if the economy was already overheating before this oil shock hit. Number 2, company guidance. What are the big software and retail companies going to say about their future? Can they handle these higher costs? And number 3, of course, is the conflict itself. Does it escalate or does it start to calm down? The answers to those 3 questions will pretty much tell us where the market is headed next. And all of this leaves us with the one big lingering question. Look, markets have dealt with geopolitical shocks before. That's nothing new. But it's that unique threat of inflation this time that makes it feel different. So was March 3rd just a brutal one-day panic that the market can shake off? Or was it the first tremor of a much bigger economic earthquake still to come?